Okay, that's a very small crowd today. I think we're still expecting people to trickle in from outside, but I'll get started. Like Prem mentioned, we have spent all day speaking about equity. We've understand the nuances of it. We recognize the volatility behind equity. But here we're going to discuss about one of the most exciting opportunities in global finance, and that is private credit. Just to maybe, take a step back, you would all know the private equity giants, KKR, Brookfield, Blackstone, Apollo, Ares. All of them have delivered excellent returns for their investors by deploying in private equity. But now these very same private equity firms are all large private credit firms. And that is global capital that is bringing conviction. And market, of course, has blown up already to $3 trillion, and it's rapidly moving towards the $5 trillion mark across the world. Now, within India, is it just a tiny dot on the map? Is it still a footnote? Back in 2012, it surely would have been. Right now, it's not. It's a $25 to $30 billion market already. And in the first half of 2025, saw about $9 billion deployed So about $9 billion deployed in the first half of 2025, and this is across 79 deals. It shows market maturity. It shows that Indian companies are ready for private credit. So what is creating this momentum in India? How is this, is this a sudden splurge? Is this something that's been happening gradually, or is it a structural shift? So what we've seen at Northern Arc or at other private credit firms in the country, and how we're looking at the opportunity is very different. We'll come to the opportunity, but before that, India specifically has raised billions of dollars of institutional capital within private credit. While large private credit firms are setting up space in India, it is important to understand that boutique private credit firms are actually raising significant amounts of capital, combining their on-ground expertise. India's economy is definitely not slowing down. Several people may say that it has peaked. Valuations are at an all-time high, but it definitely hasn't slowed down. There's a continuous journey up to being a global economy, global country. And what we've seen is that domestic demand is strong, consumption is increasing, inflation is slowing down, and RBI itself has taken several, regulations and guidelines to sort of improve how Indian markets operate. So where is all this demand coming from? Where is billions of dollars of capital going? And if that's the case, what are banks and financial institutions doing if there is so much scope for private credit? So the heart of the opportunity definitely lies in mid-sized corporates. So we are looking at companies that are north of $100 million in revenue, and they are currently private companies, healthy cash flows, healthy balance sheet, very strong fundamentals, but they need capital to grow, scale, acquire other companies, and rapidly move into becoming a public company. Now, banks do want to lend to this segment, but what's stopping them? There are regulatory restrictions and constraints that they need to meet. They are unable to move past bureaucratic, internal guidelines that do not let them execute deals with speed and flexibility. Equity is expensive and dilutive for these private companies who have hopes of going and hitting the public market soon. What's then stepping in is private credit. Private credit has the capability to shape how companies, unlisted companies, move into the IPO and then become successful listed companies. Now, what we're looking at is within private credit, what really is the game changer is speed, flexibility, and customized solutions to their debt requirements. So their requirements are predominantly for growth capital, and for acquiring other companies, it could be for working capital, project finance, several other end uses. But the way the capital needs to operate is also very bespoke. These companies need structured, tailored solutions to meet their requirements, and credit AIFs and private credit funds are the ones to make that happen. So back in 2012, private credit in India was still a $500 to $600 million market, but now we see that it's come to 25 to 30 billion. That's a 10x growth. We have 25 to 30% CAGRs at which it's growing, and we have complete regulatory backing. There are several things that have structurally helped private credit grow, which is RBI regulations, IBC, which has definitely transformed the enforceability landscape and made it easy for private credit AIFs to stand in line with banks and other financial institutions when it comes to recovery. And the entry of global institutions, the rising pool of family offices and HNIs, that has definitely made private credit more mainstream than it was a niche earlier. Now let's see where the money is going. So if a preliminary look at this would show that it is predominantly going into infrastructure and real estate. And an example of a deal would be how the Mumbai airports raised about $750 million in credit financing to be able to complete its operations. And while these are important segments to operate and has actually showed traditionally, historically showed a lot of good returns, consumer, healthcare, auto ancillaries, industrial goods, all of these are segments that are showing year-on-year growth. We are seeing that these are investable segments with companies that are growing and showing their EBITDA profitable, their PAT profitable. All they need is committed capital to be able to achieve their goals. If you notice an interesting trend, it's that at least 20% of deals are beyond the $100 million mark, which is actually showing that this market is maturing. We are seeing that companies are becoming larger and more absorbable by global credit. These are some of the landmark deals that we spoke about. That would be the Manipal Education. So within healthcare and education, we're seeing about a deal size $600 million. Within paper, we're seeing $360 million. Hydropower, which I'll come to, green and climate energy, it's an important area for us. Aerogrid hosting solutions, that's raised about $340 million. So digital infrastructure is an interesting trend. Now, just to go back to how private credit funds are able to do what banks and financial institutions are not able to do, and why is it attractive for investors? Speed and flexibility is one, but also, are you able to give them back-ended structures? Are you able to give these companies the flexibility to repay in a timely manner, but in a staggered manner, so that they are able to accomplish their goals, but also return capital to investors? Historically, default rates in private credit has been less than 2%, and within the 2%, recovery rates are about 65 to 70%. And that is all thanks to guarded regulations in the country, as well as IBC's important role. In the private credit segment, the exited deals IRRs are between 15 to 21%, and that's an important connotation of how companies are willing to pay this premium. And why do they pay this premium if they're already bankable? If banks can already lend to these institutions, why do they still pay a premium to private credit AIFs? And the main reason for that is that we have something called complexity and illiquidity premiums, and this is something that banks would not be able to meet. And we are able to structure, and everything lies in how complex the structure is, which is actually alluding more to the fact that this suits a sophisticated investor in this day and age, whose requirement is also, not to have capital flowing in quite frequently, have capital invested for a long period of time, lock in yields, which is the most important piece given the falling interest rate environment in the country as well as global. Now, all of these returns that we're speaking about, at the core of these strong private credit returns is disciplined underwriting. And at Northern Arc, at any private credit fund that you would want to evaluate, the differentiator would definitely not just be capital. It is about how do these companies underwrite, what are the risk mechanisms that they have, what is the technology-based credit assessment capability that these institutions have to underwrite these large companies. And now, like everybody else, there is complete focus on corporate governance, promoter integrity. How do the cash flows look like, and are they able to, is there a repayment capability? Are there financial covenants that are being tracked? What are the early warning signals? How can you make a timely exit, which is simply not possible in equity as it may seem. But what is more important here is that there are at least 2 to 3 ways to exit opportunities in private credit based on early warning signals that may come in. And the other important piece is companies are healthy enough not to borrow at a slightly higher rate. But what we do see here is that we welcome these prepayment opportunities. We welcome companies who come back and say, we do not need this debt anymore, because we're able to cycle the credit that much more frequently and generate that alpha as a private credit fund. So these are some of the typical underwriting mechanisms. There's of course the 5 C's that are very critical to how underwriting happens. But beyond that, what are the deep foundational relationships with promoters and companies that that AIFs are able to establish? Do we have a more transactional relationship or do we have a more deep relationship? And proprietary deal pipelines. The only thing that will differentiate a fund is how they originate. It's originate, originate, and originate. And what really ends up as the outcome is not just scaling up of the AUM, but scaling up with proper credit adjusted outcomes. Another important opportunity within private credit is green and renewable energy. And we are seeing that it's not just mid-sized corporates that are looking beyond bank financing. These companies which are into renewable energy, solar, hydropower, hydrogen, they're coming up with significant innovations that simply require significant amounts of capital. And banks may not understand the business model, and it requires specialized fund managers to be able to put pen to paper and understand the business, visit these sites and see what is the carbon replacement that these companies are able to achieve. And the scale is enormous. There is $170 billion of unmet credit demand, and the current flows are only about $30 to $35 billion. So now this has opened up a huge private credit opportunity. I would say that at least 40% of the deal flows that come to us in the entire ambit of private credit would be renewable energy deals. And there's complete differentiation in how promoters operate. Each of these segments have government support. There is a lot of push from important regulatory organizations to ensure that there is climate mitigation, climate adaptation. And these solutions require bespoke capital, and that is what private credit AIFs are offering. And the returns, the companies that are actually acquiring government projects or private projects to be able to make these climate mitigation changes are able to generate significantly high ROEs, and that also translates to a strong private credit return for our funds as well. Like I mentioned, how a platform is differentiated is definitely not merely on the amount of AUM that the company has built. It is the capability to originate, capability to maintain relationships, and the most important is timely exit. Are you able to track a company, and are you able to come out and then generate beyond fixed income returns through that exit? And this could be in the form of equity kickers. We do not specialize, while private credit funds do not specialize in equity kickers, these are other ways to increase your return by linking them to valuations, linking them to how the EBITDA performs, how the revenue growth drivers are. So there are several ways to bring that alpha to a fund, and it's all in the mind of a private credit manager, and that assessment becomes very critical when multiple platforms are being evaluated. So why private credit now? Why is this something that is just beginning to become an opportunity, or is it always there? We believe that the opportunity is right here and right now. In a falling rate environment, it is important to lock in yields at this point of time. And I think the next few months, the next few years are going to be a game changer for private credit. And it has already shown a 10x growth in India. It has shown 25 to 30% compounded growth rates. And no country in the world can beat India's compounding growth story. So we definitely believe that it is right. It is a good time to start investing, make allocations to India within the private credit and fixed income segment. And we believe that at least 30% of APAC fundraising could move specifically only to India. Now, just to conclude, as investors, asset allocators, and market participants, it's very important for us all to help shape the next decade of India's financial ecosystem, and which is actually being driven by debt as much as it is by equity. We need to make sure that we're able to understand this segment, and it requires some level of more customized and specialized understanding of the segment, while it might be much more mainstream and mainstream for investors to understand equity better. Private credit is definitely not just an asset class. It is forming a core part of institutional as well as retail portfolios. Thank you for engaging me on this discussion, and I look forward to discussing separately and taking up questions as you may need. Thank you.
So, Archana, first of all, I wanted to ask you, what's the difference between a mutual fund, a debt mutual fund, and private credit, AIF?
So private credit AIF, significantly the difference comes from the fact that this is largely unlisted companies. They might not be listed on the stock exchange. They might not necessarily be rated a AA or a AAA category, which are extremely liquid, and they are tradable on the stock exchange or tradable outside in the fixed income segment. Private credit requires a fund manager to source specific investments in the unlisted companies segment, which require large amounts of capital for specific end use. So that's the major difference as to the end use financing and timeliness of it. So debt mutual funds invest in commercial papers and NCDs of large corporates, while private credit identifies the opportunity in the unlisted segment.
Great. And what would you think would be the premium that people could expect to earn over a typical medium-term or a long-term debt product, mutual fund debt product?
Yeah, that's a great question. Like I mentioned, there is a complexity premium. We call it that because of the way we structure transactions. The returns to investors ahead of debt mutual funds the alpha would be at least 300 to 350 basis points, just because of the way that a specialized AIF operates and is able to identify opportunity.
Great. Thank you, Archana. Here's a token.